In this example video, we are going to look at both the investing activity and financing activity section of our statement of cash flows. So indirect method versus the direct method only ever impacts your operating activity section. Under either method, both investing and financing activities are reported the same way. So when we're thinking about investing activities, think basically about what you would invest your money into on a personal basis. So you would invest your money into maybe buying a home, maybe buying a new car, maybe investing in your retirement or buying some stocks or bonds. Same type of thing for businesses. When you're thinking about investing activities, think about anything that the company has purchased, again, for cash, because it's our statement of cash flow, or sold for cash of non-current assets. So again, that would be some of their investments. That could be any of their long-lived assets like intangible assets or fixed assets. For financing activities, again, think about how you personally finance yourself. You finance yourself through debt and equity. Debt, maybe that's a student loan, maybe that's your credit card, a mortgage, and through equity, ownership, right? When you actually get paid your paycheck, for working, you've earned that. That's yours. You don't owe anybody anything for that. Companies do the same way. So we're thinking about financing activities. We're thinking about long-term debt. So the issuance or payment of any long-term debt like bonds or notes payable or mortgages payable, and equity, the issuance of common stock or preferred stock, and also potentially the payment out of cash dividends because those go out to your stockholders. So in this case, they told us that the Ross Corporation purchased a warehouse for $45,000. They paid $1,000 in dividends. They sold land of $7,900, and they issued $25,000 of common stock. They tell us that all of these were cash transactions, and they want us to show how we would be reporting that in our investing and financing activity section. And again, if it's cash provided by investing and financing, that means that our cash inflows are greater than our cash outflows. If it's net cash that's used for either investing or financing activities, that means our cash outflows exceed our inflows for those activities. So we're thinking about investing activities come before financing. So we have the payment for the purchase of a warehouse. And we spent, they told us, $45,000. But we also actually sold a non-current asset, and we sold land. And by selling our land, we got $7,900. So when we net the two, we still have outflows greater than our inflows. We spent more cash on investing activities than we received from investing activities. So this is going to be our net cash used for investing activities. For financing activities, we had a payment of dividends. So we spent $1,000 in cash to pay out something to our stockholders. And we had the issuance of our common stock. So we sold more shares of stock. We sold more ownership in our business. And by doing so, we got $25,000. So when we net these two numbers together, we have a positive $24,000, which means our cash inflows were greater than our cash outflows. So we have net cash provided by our financing activities.